Hello, Martin North, John Adams, in the interest of the people. Hello, John. Good to see you again.
Hello, sir. How are you going today?
Very good. Now, we've got a rather interesting discussion today about IMF documents.
Yes. I have to congratulate you, Martin. I thought your interview with Eddie Hobbs from Ireland was very fascinating. Even though I've read a lot about the Irish stuff, having someone who was there in Ireland on the ground and can sort of tell us what was life like in the lead up, what was life like during, and what has happened since. Very illuminating. We had a conversation last year with Sean Quinn, and Sean was there prior to the crash and had left the island and came here. So we got some insights from Sean, but Eddie took it to a whole new level. And there was quite a few things that Eddie said that the parallels between Ireland and Australia, there were just things sort of like just whizzing through my head. I thought it'd be worth to have a conversation about those. But also, he said in the interview that in 2007, the IMF gave Ireland a clean bill of health. So I actually went off and read the IMF report, and I was shocked with some of the content in that report. And I thought, well, let's talk about some of these parallels between Ireland and Australia, and let's talk about this IMF report that the IMF issued in 2007.
Yeah, great. And just on Eddie, I think it's a remarkable interview, actually, because we were able to go through the whole cycle before, during, and after the crash in Ireland. And some of the things that Eddie highlighted, I think, are really, really important. We'll put a link through to that particular episode.
So now, before we go into some specific stats about Ireland and Australia, a few things that Eddie said that I thought really resonated with me that are comparable is a debt bubble in Ireland. We have a debt bubble. There was obvious warning signs before officialdom said anything. We have a whole bunch of warning signs that we've been covering for the last sort of 9-10 months throughout all of these programs. Media propaganda, basically no problem. Everything's fine. That happened in Ireland. That's happening in Ireland. Now that we're having the process of unwinding, what did Eddie say? Eddie said that the academics in the media said soft landing. Well, we have effectively people in the press saying soft landing. We have people in the bank economists saying soft landing, 5%, 10%, 15%, but no systemic crisis, etc. We have this cash for common economists. Now, I have been accused on social media to say this does not exist. So I have been very critical of certain people in the media, on social media, and saying that if you work for a bank, you cannot say what you really believe because there's fiduciary duties that you owe to the bank, and if you say certain things, that will actually impact the bank's capital reserves and what the bank must do to structure itself. So there can be no question that bank economists are not independent. Therefore, if a bank economist is on TV or on the radio giving their opinion, it is heavily conflicted. They can't. They're not going to give you the honest truth. And obviously, Eddie said to a T, 100% of bank economists in Ireland said there was no problem, even though that they had a huge problem and they suffered a horrific crash.
Yeah. So the interesting thing about these economists, I guess you can make the argument one of two ways, right? Either they are actually conflicted because of the fact that their policy that the companies actually pushing is perhaps even different from their own personal thoughts, firstly. Or it could be that they've got other motivations for actually playing down the risks. We probably don't know which is true.
You could call this soft corruption. You could call this they have professional obligations in terms of their employers. But the most important aspect of these bank economists is not what the economists say, but in terms of the media. I think the media should basically, frame these conversations with economists as saying, okay, you're about to say X. We know that you can't say Y, so tell us what X is, and then we'll go through that. But they don't do that. The media, in general, presents these bank economists, typically as the smartest people in the profession. They are the most. They're the smartest. They're the most well paid. They have the most credentials. They have the fancy PhDs, etc. And they don't give the audience the knowledge that these people are conflicted. They can't say what they really believe. They're going to give you a sliver of fact, truth. There'll be some propaganda mixed in with that. But I think to be a fair media company, you should actually try to give the audience some warning before you just put these people on TV.
And my point is this: those journalists will know that 12 months ago, that same economist was saying prices are going to go up by 5%, right?
Yes.
They never ask, but what's changed? Why have you now changed your view to the new view, right? It's like all those previous predictions that they made, up 5%, roughly neutral, down 5%, down 10%, now down 15%, right? It's like each of those is just a little snapshot in isolation. There's no understanding of why they have changed their tune over that time. And that is a big failing, I think, on behalf of the media.
Yes, and the other point to make is media personalities cannot hold bank economists to account. So they can't say, last year you only said it was 5%, now you're saying it's 15%. Why? Because the banks pay the advertising revenue to the media companies. So massive conflicts of interest. But again, they're not telling you the full story in this country. And Eddie said that to a T, none of them told the truth prior to the Irish housing crash.
Yeah.
So the last parallel that I thought was important, now we haven't really seen it in full force yet, is really about these social costs. Now, we've done the episode earlier this year about postcode 2570, about the increase with mortgage stress and people suffering domestic violence. We did, I mentioned several times last year, particularly in the episode with Sean Quinn, about increase in suicide, how people may kill themselves, in terms of increase in divorce, in terms of drugs, domestic violence, all of this sort of stuff. So I said those things because I've read it, I've seen the reports about them, I've seen the academic studies about them, and yet he's someone who received phone calls from clients saying, I think this person's about to kill himself, I think that person's going to kill himself. So I thought that was very important that Eddie was able to give us that message. But the more concerning thing is that the social horror of when this fully plays out, we really haven't sort of we haven't seen that throughout Australian society, and when that does happen, there'll be thousands, if not hundreds of thousands of people across the country who will suffer some form of significant social cost.
Yeah, and that's a really important point, I think, John, because it is the social dimension, right, rather than the rational economic dimension, which I think, for me, Eddie really highlighted, right, because these are real people with real issues with regard to their debts and their finances, right, and there are consequences, right. And my argument is that many of the people who ostensibly are in charge, and I think some of those in government, and certainly the people at the RBA and APRA, are just looking at it purely from a rational economic perspective without thinking through the consequences more broadly. And that was precisely what was happening in Ireland as well. So it's the same old, same old.
Yes. And the point I made, I think, this year and last year is, if these professional, rational, so-called judgments are made, now I think that there's nothing rational about what the RBA is doing, but if they make a mistake and there is horrific social cost imposed on the in terms of people across the country, well, the officials generally are not held to account. Yep. And general, if this is gross professional negligence, there has to be jail time. And I'm willing to say that I think when this blows up, and a lot of people across the country are suffering, the head of APRA, the head of the RBA should go in front of a court, should defend their decisions, and if they can't, in the court of public opinion, justify why they screwed the economy so bad, they should go to jail. So I feel quite strongly about that, because here I am being called someone who has studied economics for 20 years. People are calling me crazy, don't know what I'm talking about. These guys are put on the highest pedestal. So you get the title, you get the fancy degree, you get the big money. Well, there has to be accountability if you make poor decisions. And in my view, having looked at this in depth for a long time, they have made some very, very bad decisions.
And it's worth saying that, and Eddie made this point, that if you listen to some of the people just before the crash who were in, the equivalent of APRA, basically saying the banks are well capitalised, there are no issues at all, etc., right? Well, we've had precisely the same conversations recently here in Australia, right? And remember that those conversations in Ireland were under a year before the whole thing went.
Yes. So in terms of where to from here. So on this point of, is Ireland comparable to Australia, and how big are these parallels? Now, what I decided to do now, look, to come up with a full catalogue of statistics where you can compare, so it is hard because there's different ways to measure some of these metrics. There's different ways that the data is collected and how it's reported. So with the limited time I had to prepare for this conversation, I wasn't able to do a full comparative analysis. But what I did was I tried to pick up a couple of high-profile statistics and look at, well, what is the number for Australia? What is the number for Ireland pre-crash? What was the number for the US pre-crash? And then see if we can draw some parallels. So there's three statistics I thought that would be worthwhile to have a conversation about, and I'm sure you'll have some other things to say with your statistics. So the first one is household debt as a proportion of disposable income. So the RBA for September of 2018 said we are at 188.6. Now, Ireland rose up to about 200% prior to the crash, and the interesting thing is that once the crash happened, the number went up to 210% because the level of income fell, the debt stayed the same, and that elevated the in terms of the ratio. So you actually peak in this statistic after the crash than before the crash. But before the crash, Ireland was 200, we were 188. And the United States was at 116.3% in the first quarter of 2008. Now, that obviously should ring alarm bells that, yes, we're not at the level of Ireland, but we are substantially higher than where the US was. And this is I think this is probably the key driver behind the in terms of the announcements you make around mortgage stress.
Yes, well, this household debt thing is as you know, I think very critical. And of course, it's worth making the point that in those numbers, you've got household debt and you've also got SME debt as well.
Yes.
Right? What you should, of course, do is actually think about it not as an aggregate, but you should decompose it. And also remember that not all households have debt.
Yes,
right? The
exactly.
critical question is the third of households who are actually the mortgaged, right? What is their ratio? And I can tell you that from the analysis that I've done, our ratio is higher to the ratio in Ireland just before the crash, when you look at households who are borrowing for mortgage purposes.
Can you reveal that number?
So in Australia at the moment, right, it's about 5.5.
So 550%.
Correct.
So debt to disposable income for that cohort in that and sort of that 20 to 40 category that are in the mortgage market.
Yeah, all those people with mortgages, right, in the mortgage, it's just under 6, right, basically. Yeah. And in Ireland, it was just under 5.
Right. Okay. So the most indebted people are more stretched in this country compared to Ireland. Correct. Before Ireland went under.
And that's because our lending standards were way looser than they were in Ireland, right, to make a like-on-like comparison. So we've had lending where the loan-to-income ratio is up to 10 times.
Yes.
Right? There's very little evidence that they got as high as that in Ireland.
Yes. Okay, and that's interesting because I've seen some commentary on social media to imply that our banks are stronger than the Irish banks. But if they've given out more stretched valuations on these mortgages, you could say that there may be more risk with our banks.
Yeah, so it's true that we've got more capital in our banks today than our banks would have had in 2008 or the Irish banks would have had when they crashed, right? But the lending standards were just way looser for the last 5 or 6 years here relative to Ireland in that same situation. So it's important people understand that when you compare apples and pears, you want to make sure that you know whether you are actually comparing apples and apples or apples and pears, right? And quite often, some of those comparisons actually miss the key point.
Yes. So in terms of the next statistics, so in terms of debt to total assets, so we are today, so September 2018, 20%. In terms of Ireland, they were at 20%, and the US was at 21%. So very, very comparable. Now, one of the points on this one is that people think, okay, so your debt is only 20% worth your assets. 20% doesn't seem like it's an overvaluation, but what people from an economic point of view have to understand is the assets are way overvalued. So that's why you have this relatively low ratio. But once the crash happens and the asset prices collapse, again, you're going to see this ratio go up.
Yeah, it's the big lie, right? Which basically says, as property prices rise, I as a bank can lend more and still keep my loan to value ratios in check.
Yes.
Right? And that cycle can continue and continue and continue for as long as property prices continue to rise, right? And superficially, it looks fine, right? But the reality is that if you just look at that ratio, you're missing the point, right? Going back to my debt servicing ratio and those other things, right? Effectively, if you go along that line, you end up, as you say, roughly, around the 20% mark. But that tells you absolutely nothing.
Yep. So and then in terms of the last statistic I thought I'd pull out is in terms of net household wealth, how much of that is tied up in property. Now, so we are tied up. We are as of September last year, we are at 67%. Ireland was there were some statistics I found this morning published by the Central Bank of Ireland. This, I think, was 2006-2007 data, suggested that they were at 83%, so way higher than where we are today. But in terms of the Americans were at 48%, and obviously the American mortgage market was the first one to blow up. So that again points to that we have a substantially larger problem than the US, but perhaps maybe not as large in terms of what happened in Ireland.
Well, just be careful on one point. Ireland didn't have a statutory superannuation scheme like we have here.
That's true, yes.
Right? So there's 2.8 trillion, roughly, of savings of households, right, in the superannuation system here, which means that effectively the overall asset pool has a very different mix from the one over in Ireland, right? So just, again, got to be careful when you compare the two.
Yes. And the other point to make on this one is that China is 75%.
Yeah.
So China today, it has the biggest bubble. They have a big bubble in real estate. So of the household sector in China, 75% of their net wealth is in property. And when Harry Dent was here, when he was here late last year, he made a big point of this in some of the conversations I had with him. That China has a lot of their wealth tied up in property. So do we. The same was in Ireland, but substantially higher than where the US was with subprime going into the GFC.
And of course, asset prices, if they fall, as property prices fall, means that paper profit could be reduced significantly.
Yes. So hopefully by going through those statistics and some of those analogies between what Eddie said and what we've been saying, the comparison between Australia and Ireland, it's not obviously a 1-for-1 match, but it should be a relatively close comparator because of the overlying metrics.
And let's just make one point. There is one big difference, right? We have an exchange rate that has much more flexibility than the Irish finances had because of its connection to the euro.
Yes.
Right. So there is some protection for the Australian economy because the RBA can drive the exchange rate a lot lower, right, with all the consequences and implications of that, right? And that is one important difference, right? The question is, how much difference would it really make in practice if things started to go really bad? And that's, of course, a difficult question to try and answer theoretically.
Yes. So the key point on that. So if the RBA was to use the exchange rate to soften the blow, would the fall in property be less than it was in Ireland? the answer is yes, but it comes at a different economic cost.
Yeah.
And it creates a whole bunch of different problems around the purchasing power of the dollar, and you know, and that may lead to inflation picking up. So you know, because people on Twitter again are saying, yeah, we can use the dollar, we can use this. In 2001, the exchange rate fell to 48 cents against the Americans. We can do that again, but again, that comes at a cost to the economy that a lot of people haven't factored in as to, well, what is the implications of that in the short term and then in terms of the long term. But now going to the IMF report, so you know, I had a bit of a read. Again, you know, soft landing, all of this sort of stuff. So, but there was a couple of key paragraphs that I thought I would read because I thought they would just, just jumped out of the page. So the first one I want to read is about this soft landing. So this is IMF 2007 report on Ireland. The authorities saw a soft landing of the housing market as likely. The shared view is that any overvaluation of house prices would likely diminish gradually over time as rental income and other fundamentals grow more quickly than house prices. So house prices will come down softly. There'll be other things to counterbalance in terms of the fall of the house prices, and that's how we'll have a soft landing. Now, So obviously, Eddie said soft landings don't happen when you get these in terms of these big bubbles, and obviously that's one of the points I've made. Show me an example where you have a bubble this big that results in soft landing. I can't find that case study. So if someone can find it, send it to me. But I've put out this challenge for about 6 months. Show me how this doesn't blow up and is in some sort of bad outcome. I'm still waiting for that email.
Yeah, and it's interesting, again, more people are still saying, oh, it'll be a soft landing here. Precisely the same was happening in Ireland before the crash, and yet we know what happened there.
Yes. So in terms of the next quote is, the banking system continues to perform well, but rapid credit growth has led to vulnerabilities. Reflecting the strength of the economy, the banking system is well capitalized, profitable and liquid, and non-performing loans are low. Well, to be honest, I think I've heard something very, very close to this in the Australian context in the last 6 months. So again, IMF, the Irish government was saying that look, everything's fine. Whatever happens in terms of the housing market, soft landing, whatever, the banks can take it. And then obviously we know what happened with the Irish banks. I was at a social function about 2 or 3 weeks ago talking to someone who's a tradie. And he knows my views on this. Now, he's an economist, but he said to me, surely in 2019, we don't have to be fearful about the banks, suffering sort of any sort of catastrophic loss or the banks going bankrupt. Surely we're mature enough that these things don't happen now. And yet, here is the IMF prior to the housing crash in Ireland saying the banks are fine, and yet now, I mean, you may have a view on this as to the level of, in terms of the mortgage book in terms of the overall loan book for banks, how much of that is concentrated in property in Australia, and how was that number sort of compared to in Ireland?
Yeah, so we've got well over 60% of all lending for residential property in Australia in the banks, right? It's a very high number. In fact, in Ireland, it was just a little higher than that just before the crash. That was because essentially they didn't have quite the diversity in their economy that we have, right? But we've got this massive bubble in terms of asset prices, as we discussed previously. And what that means is that we've got a significant proportion of loans that are actually lent on property that is massively overvalued.
Yes.
Right.
Yes.
And that's precisely the same as Ireland, right? And in fact, the ratios are somewhat similar, right? There is a difference. We do hold more capital now because of the Basel rules have evolved. And so if you compare the capital that we have today with the capital the bank had in Ireland, we have more today. The question is, have we got enough? Right?
Yes.
And it's worth reflecting on the fact that the Reserve Bank in New Zealand has come out very recently and said that they're going to impose additional capital requirements on the New Zealand banks because they're of the view that the capital is insufficient, right? And APRA is also now pushing for greater capital in Australia as well. So we're on a journey towards more capital. We're still not there yet. My argument is that looking for a capital solution to solve a banking crisis is probably very myopic anyway.
Yes, yes. And you know, the last quote I thought I would share is about stress tests. Now, we did a show last year about the APRA stress test. Now, they came up with a scenario. You and Lindsay David from LF Economics showed that the calculations that that APRA put out based on that scenario were way off by about $250 billion. And I showed that the scenario that APRA put forward was so bland that they haven't modelled, or they haven't shown publicly what happens when you have a severe housing crisis, banking crisis. Because I suspect if they showed it, it would show that the Big Four would basically collapse, and we could go into some sort of severe depression. But either they haven't done the work, or they can't tell the public because it's going to further diminish confidence. But on stress tests, people are saying our stress tests are fine, and the IMF said something very similar about the Irish stress test. And so here's the quote: "Stress tests by the central bank indicate that the major lenders have adequate buffers to cover a range of shocks. Even in an extreme scenario involving a sharp rise in unemployment and a sharp decline in house prices, capital remains adequate at every bank. In addition, even a very substantial withdrawal of private sector deposits would not exhaust any major lender's stock of liquid assets." Well, that is the most fallacious, incorrect statement you could make. So wrong, and yet we hear this in this country. I've heard something very similar by APRA, by the media, by the establishment over the last 6 months.
And it's worth saying again, the thing about stress tests, if you stress test an individual bank in isolation,
yes,
right, you might get a reasonable result. But what none of the stress tests do is to actually put Bank A and Bank B and Bank C and Bank D all in the same pool, all trying to grab capital from a market that's completely locked up now, right? And so it's the network effect across multiple banks and multiple entities that is the missing bit of the puzzle. It was also true in Ireland too. So doing stress tests in isolation are meaningless because the real world is connected.
Yes. And look. So we've looked at the Irish sort of commentary, but we know that the IMF released a report about Australia in terms of last week. So there's a lot of interesting things to unpack out of the report. But they did have plenty to say about the state of the economy, the state of the banks, the state of the housing market, and what are the risks to Australia and to Australians. So this is from the IMF 2019 report on Australia. Quote, "While macroprudential measures have contributed to the easing of pressures in the housing market, and a soft landing of the housing market is the most likely baseline, there are risks of a stronger downturn. A sharp correction in real estate markets could lead to a vicious feedback loop of falling real estate valuations, high non-performing loans, tighter bank credit, falling consumer confidence, and weaker growth as happened during the GFC." So at least in the second paragraph, they had to acknowledge that things could unravel. So it wasn't all sunshine, but they did. What did they say? The base case, most likely scenario is a soft landing, and Eddie says that doesn't happen. I haven't seen it in any sort of previous crash, and the fact that they said it in 2007, they're saying it now. The parallels are very stark.
Okay, John, so we've heard about the IMF and Ireland. We've heard about what the IMF said here. So what does that tell us?
What does that tell us is that the Irish were completely unprepared. We are completely unprepared. I mean, this is why for the last 2 years I've been banging on the doors of certain politicians in Canberra and saying that in the history of Australia, we have we have the complacency model, we have the she'll be right model. We don't prepare for things. We basically just sleepwalk into a crisis, and it would appear that the parallels are so stark. It looks like we're going to be repeating history, and time will tell whether the decline in house prices in Sydney, Melbourne, now. So there was the data came out last week that said that the annual decline in house prices in Melbourne in the last 12 months was the biggest on record. For Sydney, it was the biggest since 1983. Now, in the last couple of days, Moody's in the US have said that this slump that we've seen, particularly in the share market in the last 2 months, it's only a minor blimp, and they think that things will start to pick up going to 2019. Now, that is a lone voice, so it's either potentially Armageddon has started and this is going to unravel throughout 2019, 2020, or it could be that this is just a temporary slump, and whether domestically or internationally, and things could start to pick up into 2019, because Moody's actually said that they think that things will pick up again going over the next 6 months, and that the US Federal Reserve will get back to raising interest rates. So that's a very big call. I was very surprised by that call, but it's either the Armageddon has started and we're going to see this unravel going forward, or it could have another leg up, and it could be delayed for another 12 to 18 months.
Right, but meantime, we've got home prices continue to slide here in Australia, right? No evidence that that's turning around at the moment. And the feedback loops of lower appetite from buyers to buy into the market, right? Lending's still tight, which is why I still think that the trajectory of home prices is going to go down. And I still think my 20 to 30% peak to trough, irrespective of what happens internationally, is still a reasonable call. If that is true, then effectively we're on a slide that we can't stop, and there's more downside ahead.
Yes. Well, the one final point I will make is, Eddie talked about how you've got new housing estates, particularly quite away from Dublin, and basically you don't have one or two buyers. Well, there are some newer housing estates in southwest Sydney, and I had anecdotal feedback over the weekend that the developers are really struggling to find. They are slashing prices. They are trying every trick in the book to get people to buy. They are getting no bids. And in some cases, you have hundreds of houses in southwest Sydney just sitting idle, and it's another parallel between what happened in some of these new developments in Ireland and what we are currently seeing now in southwest Sydney.
Absolutely. Liverpool is down 23% on those new estates, right? And I believe that once you get over that 20% blip, as it were, then the next move is definitely firmly down. So I think we're going to see more of that ahead. Worrying times, isn't it, John?
Yes. We're getting close to the point where all the warnings that I've been trying to make, you've been trying to make, are starting to come to fruition. And, there are certain people who have listened to us for the last few years and who have made prudent financial decisions to protect themselves. But just like Eddie said, when you get this wrong, it's a life sentence. People 10 years on an island are still stuck in these mortgages, still being chased by lawyers and bankers and a whole bunch of other vultures. And I suspect there are certain people in this country who have already been served a life sentence.
Well, hopefully those who've been following in the interest of the people are at least a little bit more forearmed. John, thank you very much for your time.
Thank you.
Thanks. So there you are. A rather sobering message, I'm afraid, but it's important for people to understand what's really going on so you can plan accordingly. It's Martin North, John Adams, in the interest of the people. See you next time.